Welcome to this explainer. All right, today we're putting on our senior value investor hats for a really rigorous Buffett-style deep dive into Entravision Communications, ticker EVC. This is an investment committee pitch based entirely on their most recent financial documents and market data. We are looking at a legacy media stock that just saw its revenue literally explode, which obviously triggered a massive stock rally. But as value investors, you know the drill. We have to ask, is this a genuine long-term compounder we're looking at, or just a temporary flash in the pan? Let's get right into it.
Okay, so let's start with this massive number right here, 114%. That represents Entravision's first quarter 2026 year-over-year consolidated revenue jump. They hauled in roughly $197 million in just a single three-month period. Now, in the world of established communication stocks, your top line simply doesn't double overnight like that unless there's been a fundamental transformation of the company's financial profile. It's exactly the kind of top-line expansion that immediately demands a look under the hood.
To understand where that 114% growth came from, we need to look at the structure of the company. Section 1. Business and Moat Comparison, a tale of two businesses.
We're essentially looking at a classic split personality operating under one corporate umbrella. On one side, you've got their traditional legacy media segment, which is television and radio broadcasting targeting Latino audiences. This legacy side is struggling. It's dealing with shrinking margins, posting an operating loss of over $5.2 million just this past quarter. But then, on the other side, you have their advertising technology and services segment, or ATS. This side is absolutely booming. They're utilizing programmatic AI to empower mobile app developers globally, and it just drove a massive $34.3 million in Q1 operating profit. So, let's run this setup through our standard Warren Buffett checklist. First up, is it an understandable business? Yes, absolutely. Media broadcasting and digital ad tech are pretty straightforward. But do they have a durable competitive advantage and economic moat? Well, here's where it gets heavily skewed. The media segment has virtually no moat and faces fierce competition. The ATS segment, however, is definitely carving out a narrow moat using its proprietary AI to automate global media buying. What about consistent high returns? Definitely not yet. Their trailing return on equity sits at a rather painful negative 22.7%. And finally, able and honest management? Yes, actually. They clearly communicate their strategy and are actively using their cash to pay down debt, which we love to see.
And honestly, management is very well aware of the drag from their legacy media anchor. CEO Michael Christensen was super candid on the recent earnings call, spelling out their strategy to capitalize on the upcoming 2026 political ad cycle. With major governor races happening in California, Nevada, and Texas, plus all those critical House races, they are really banking on that political spending to inject some much-needed cash into the struggling media side of the house. Because let's be real, in the media business, nothing pays the bills quite like an election year.
So let's see how all of this builds into the raw numbers. Section 2. Deep Financial Comparison, Under the Hood.
Looking directly at the Q1 2026 income statement pulled straight from their filings, Entravision executed a massive bottom-line turnaround. I mean, they shifted from a brutal $52 million operating loss in the first quarter of last year to a $20.6 million operating profit today. Net income to common stockholders also swung from a nearly $48 million loss to a $12.3 million profit. Now, to be fair, this was definitely aided by the fact that those massive impairment and lease abandonment charges from last year didn't repeat, but it's still a huge swing.
Breaking down the actual data, we can see exactly where this leverage is coming from. The ATS segment's staggering 204% year-over-year revenue growth is doing practically all the heavy lifting. Media, meanwhile, only grew by 4%. But as value investors, we can't ignore the red flags screaming at us from the consolidated metrics. We've got that negative 22.7% trailing return on equity and a massive 323 times debt-to-equity ratio. So yes, earnings quality is improving rapidly, but that historical drag is still heavily visible on the balance sheet.
Speaking of the balance sheet, let's look at their liquidity. Despite carrying all that debt, they actually maintain a really healthy cash position. They're sitting on $71.1 million in combined cash and marketable securities against roughly $162 million in total long-term debt and current maturities. Having that strong liquidity is what allowed management to easily cover a $5 million scheduled debt paydown this quarter, all while continuing to pay out a 5-cent per share cash dividend to their shareholders.
Now for the core of our investment committee pitch. Section 3. Quantitative Valuation Models. What is this business actually worth? And does the current stock price of $8.87 make mathematical sense? The absolute crucial point here is figuring out the intrinsic value. So we built a discounted cash flow model using their $17.8 million in Q1 free cash flow. If we assume a base scenario where that ATS growth normalizes down to 10% and media just stays flat, our model outputs an intrinsic value of about $6.50 per share. Now, if we look at a bull scenario, factoring in sustained 20% ATS growth and a huge 2026 political ad boost, that pushes the value up to $9.20. On the flip side, our bear scenario drops it all the way down to around $3.50.
But if we step back for a second and just look at the multiples, Entravision is currently trading at a staggering 136 times trailing PE. Just let that sink in for a second. For a value investor, that number is astronomical. On top of that, its enterprise value to EBITDA multiple is sitting high at 21.8 times. This is a massive premium over its historical averages. It tells us the market is already pricing in some incredibly intense sustained growth expectations, primarily banking on that ATS segment.
Let's double-check our work by applying the classic Ben Graham intrinsic value formula. Now, without boring you with the underlying algebra, when we plug in their annualized earnings and assume a 5% AAA bond yield, the math tells us one thing very clearly. You would need absolutely near-perfect, sustained long-term growth over the next decade just to mathematically justify today's $8.87 stock price.
In fact, if we do a reverse DCF reality check, basically working the math backwards, it tells a pretty wild story. Remember, this stock rallied from $2.88 at the end of 2025 all the way up to $8.87 following this latest earnings report. Back-solving that current price implies the market fully expects that 204% ATS growth to carry the entire company's valuation for years to come, effectively ignoring the continuous multi-million-dollar losses happening right now in the legacy media division. Which brings us to arguably the most important concept in value investing. Section 4, Comprehensive Valuation Summary and Margin of Safety. We always demand a buffer between price and intrinsic value.
Despite the absolutely phenomenal Q1 financial turnaround, our model suggests the current $8.87 price already prices in a near-perfect scenario. When we compare that market price to our base intrinsic value estimate of $6.50, we're unfortunately looking at a negative margin of safety. For anyone requiring a 25 to 30% discount to intrinsic value to even initiate a buy, Entravision currently screens as overvalued.
So the real rub here is this valuation disconnect. Yes, 114% overall growth is fundamentally transformative, no doubt about it. But that legacy media segment is still acting as a very heavy anchor, losing over $5 million this quarter. Because you've got this ad tech rocket ship literally tied to an anchor, the consolidated valuation is quite steep for new capital. The near-term upside appears highly restricted by the valuation that's already baked into the price.
Let's wrap this up with our final recommendation for the investment committee. Section 5, the final Buffett-style verdict.
Warren Buffett famously stated that he wants to buy a wonderful business at a sensible price. So knowing everything we know now, we really have to ask ourselves, is Entravision a wonderful business at a sensible price right now?
Well, based strictly on the filings and the data, Entravision is really only half of a wonderful business attached to a struggling one. And it's trading at a price that honestly isn't particularly sensible for allocating new value-focused capital. Therefore, our official recommendation today is a hold if you're a current owner enjoying the recent momentum, but a hard pass for new buyers looking for a real margin of safety.
So I'm going to leave you with this final thought to chew on. Will Entravision's programmatic AI ad tech completely eclipse its legacy roots, or that heavy media anchor eventually drag the stock's massive rally right back down to earth? It's going to be a fascinating tug of war to watch. Thanks for joining me for this explainer, and remember, always demand a margin of safety.